So, what is the yield curve? As I've said, it's kind of a line. Obviously, that is very fictitious. If you go to Bloomberg, you'll see the yield curve has gaps in it. So the yield curve could look like that. If it's got gaps in it, that just simply means that products or interest rate products are not available at these time horizons. So it's quite gappy. For instance, if you looked a couple of years ago at Greece's yield curve, it just looked like that. Because during the bailout package of 2012, European central banks and whoever gave lots of loans to Greece could buy up all their short-term debt to give them a time horizon to pay back. So they only had longer-term debt. So if you ever see a yield curve in real life, it's not as fictitious as it's not as fancy as what you see in this lecture or what I've drawn. But it's meant to be a prediction, a forward-looking graph at what the interest rates may be in the future. Regarding its predictive power, it's the best thing we've got. They're kind of predicting future interest rates. The examples I'm going to give you is based on kind of government debt. Government debt is meant to be seen as risk-free. If you have a look at this link, I think I've also got the link on the bond lecture as well. It kind of shows you the US Treasury, every couple of years, they make a new agreement to increase the debt ceiling. And they do that in order so the US government can borrow more and more, because if they can't borrow more, they might actually default on their debt. So we assume that the likes of sovereign debt is risk-free in this yield curve, but it's not always risk-free. I mean, Argentina is not exactly risk-free. I think they've defaulted 3 or 4 times in recent history on their government debt. But we see the UK and the US is tend to be risk-free, but it's not 100% risk-free if you look at the history of US borrowing. So that's the shape of the yield curve, but we're trying to say it's meant to be forward-looking. Banks will look at the yield curve when they price their products. When companies want to issue debt, they will look at this yield curve as a basis from where they want to price their debt at. So I've shown you what it looks like in a positive yield curve. But I think someone correctly said in one of the seminars that the yield curve does change. It's positive when the economies are growing strong, but in times when the economy is not going so great, it starts to become humped. When investors and the market think longer term interest rates might be reduced, that's when the curve becomes humped. It becomes completely flat when inflation's at 0, and then ultimately it flips, where the markets assume governments are going to reduce interest rates in the future in the event of a recession, therefore the yield curve's the other way around. That's what it technically looks like. It goes, well, drawn the wrong. It goes from that to that to that to that. I probably should have done it the other way around, but it goes from there to there to there to there. And obviously that's when you're going from positive time to kind of recession time. On the flip side, when you're going from recession to positive growth, it'll do it the other way around.
Does it tend to lead the recession, or does it tend to lag it?
Oh, good question. It tends to lead it. Normally, when you see when you start seeing something like this is where investors are getting nervous about the long-term prospects. So when investors are getting nervous about the long-term prospects, they start to be a bit more risk averse and potentially stop lending or stop investing and kind of crystallize whatever profit they've got. And if investors kind of withdraw their assets, then that slows down the economy. So it actually could be a precursor.
Does it tell you much about the time span of how long it will be before a recession or not?
That'd be nice.
Yeah.
No. Obviously, it's market participants. It's only used as a predictive power. Is how you interpret it. But you're right. It's a good indicator of what could happen. It's a good precursor. For full completeness, if you were ever to decompose the yield curve and see how that rate's built up, it would look like that. You don't need to remember that. It's just there for show. Some guys will have seen this last year already. I'll talk about this as one of the theories. And this year we refer to credit risk when we talk about corporate bonds. whenever you're given a debt instrument, you'll not know the breakdown. You'll not know what these are. You'll know what that is, bank base rate, but you'll not know the breakdown of them in any product. But that's the idea of what's in a yield curve. But that's just kind of a show. The four theories. You have some that are like economic theory and some that are behavioral theory, how investors react. So these are kind of four to remember, so let's think about it. If this is a multiple choice question, I could kind of mess up one of the names. If it was a 4-mark question, this is one of the four theories of the yield curve. If it's an essay question, you could write all four, put a picture of the yield curve like that diagram, and then write about each one briefly. So it's worth revising these. So it could easily be a 2-mark, a 4-mark, or a 10-mark. Okay, so that's why I'm doing a lecture. So I'm going to cover them in turn. The expectation theory takes a little bit longer. There's a bit of maths involved, but the other ones are more behavioural. Expectation theory is you expect, or the market expects, shall I say, that future interest rates follow the path of short-term interest rates. So you'd expect one 3-year product, obviously I'm going to say bond, is the same as 3 1-year bonds in a row. So the kind of substitutes. You'd expect if you've got a 1-year bond, that ended in the year, obviously, that ended in the year, you'd roll that over at whatever the new interest rate is. Then again, you get the next bond, roll that over at the new interest rate. Your rate of return should be the same as just getting a 3-year bond and holding it for 3 years. So that's what expectation theory is all about. It's upward sloping because we believe it to be upward sloping. If it's coming down, it's because we believe interest rates are going to drop and come down. So I've got an example here, some maths, so you can see what I was eating at the weekend. We have Roses PLC wants to issue a 1-year bond at 8%, and then we've looked at the yield curve, what we expect. Another product from Quality Street PLC, they have a 2-year product at that and a 3-year product at that. Now I'm going to show you the maths behind 2 1-year bonds and a 2-year bond will have a rate of return the same, and that's the idea of expectation theory. If I plot on a graph, you have the 1-year bond there, the 2-year bond there, 3-year bond there. Plotting the curve, I'm going to show you the maths of kind of how that and that, the two products, explain expectation theory. The assumption, however, is that the bonds have equal characteristics, i.e. they both have the same default risk. We assume there's no arbitrage. You can't we expect the market's efficient, and you can't take profit from price differences here, is the assumption behind this. It's not financial magic. I'm going to show you the maths behind getting a 1-year product, that comes to an end, and then using the forward-looking yield curve, the interest rate goes up. We'll say how that impacts your return when you do the 1-year product, another 1-year product, and then compare that to a 2-year product, is what I'll do the maths here. So that's what I've said there. I'm not going to do the maths for the 3-year product, but it's exactly the same. So the assumption is that they're substitutable. You're not really bothered if you have a 2-year bond or 2 1-year bonds in this example. So that's the assumption behind the theory here. So I've drawn it out. You have 2 options as an investor. You either go to Roses and buy their 1-year bond and then roll it over in a year's time when you expect interest rates to be higher, which said in a year's time you expect interest rates to go up 10%, or you can buy a 2-year bond from Quality Street from them. You're not bothered which one you invest in. So where these prices or the interest rates derive from is, we'll do a bit of maths. Option A, bonds, which we'll talk about here, is simple interest. Okay, it's not compound interest. It's simple interest calculations. So if you buy a bond, then in a year's time you buy another bond, you don't compound the interest. It's simple interest, then another simple interest calculation. So option A, you get a 1 year bond at 8%. Obviously if the par's of 1,000, you'll return back 1,080. And then in a year's time, you'll invest that whole 1,080 into the new bond at 10%. So your rate of return, or what you'll receive in 2 years' time, will be 1,188. Because it's just two simple interest calculations added onto each other. So that's option A. So in order to work out the interest rate for the 2 year bond from from Quality Street, we basically do the deduction backwards. So option B, if the rate of return is the same at 1,188, because it's simple interest, we know that you've got year 1, year 2. We can we could obviously put that to the power of 2. So you know your rate of return is going to be that. You know you're going to start with 1,000. Therefore, what is the interest rate you have to achieve on that bond to turn 1,000 into 1,188? Technically, if there's no arbitrage exists, therefore the 2 year bond should have that interest rate. So you can either have invest at 8%, roll that over in a year's time at 10%, or you can just start off by putting the 1,000 in a bond at that rate, and you should return the same 1,188. If you do this, if I was to do that, obviously I haven't done this, you could do it again to get see what the return of rolling 3 bonds over, do the same calculation backwards, you would achieve the 9.5%. So that's kind of the maths behind expectation theory. But to write, you don't need to do the maths, but if you want to just make sure you understand it, is that investors believe that these two are substitutable. You should return the same on either a bond at 3 years or 3 1 year bonds in a row. And that's kind of the maths behind it. Technically, you should be able to get an example by looking at government debt from the same country and kind of see the price of look at the interest rate on them bonds and do that, and they should kind of produce a yield curve. But you don't need to do that. So that's expectation theory. Liquidity preference is more behavioural, about the investor's attitude. If I ask you now, what's going to happen in 30 years' time? You're shaking your head. What's going to happen in 30 years' time? No one knows? What's going to happen next week? So liquidity preference is bondholders or people that invest in debt in interest products are risk averse by nature. Bond investors are more risk averse. And they don't like investing for the long term because they don't know what's going to happen in 30 years' time. So liquidity preference theory is the longer you hold the bond, you want to be compensated more for investing in that product. If you're going to hold something for 30 years, you want you want to receive a higher rate of return than something you're going to invest in for 2 years. Because you need to be compensated, because we have no idea what's going to happen in 30 years' time. So that's kind of the easiest way to explain liquidity preference. You're locking your money away because you're holding this product rather than cash, and you're holding it for a very long time. Therefore, if you link it back to last week, kind of deferred consumption, you're kind of locking your money away for a long period of time. You want to be rewarded. So that's the easiest way to explain liquidity preference. On the flip side of that, the person lending out, the company that's issuing the bond, they prefer to lend for longer than shorter. The UK government, for instance, they tend to borrow longer term than shorter. The US government tend to borrow short term rather than longer term. That's why they keep having them shutdowns you may have seen on the news occasionally, because their short term debt is monstrous. The UK, we prefer to lend out long. and spread the debt over a longer period. The US is quite the opposite. So that's liquidity preference. Any idea what the term preferred habitat is? Or another word, what's a habitat? Is your home? My home is Bloomberg, not in a lecture theatre, so I'm outside my comfort zone. I prefer my habitat. I've been in the Bloomberg room, Bloomberg laptop, in the terminals. That's my comfort zone. If I'm going to go outside that comfort zone, do something else, I want to be rewarded. So preferred habitat is all about investors. If they go outside of their comfort zone, i.e. they lend longer rather than shorter, they want to be compensated. If you want to get a bond investor, naturally risk averse, to invest over 30 years rather than 5 years, you need to compensate them more, hence the shape of the yield curve, compensate them more for going outside their comfort zone. So that's all about comfort zone. It's kind of in the name. So you can read the spiel and how it links to others. But again, that's more behavioural. It's not economic, it's behavioural. It's kind of the incentive for the investor.
How does this explain how it flips? Because obviously, why would you pay more interest for a shorter time horizon?
So this is behavioural, not economic.
Alright, okay.
Obviously, in the times of crises and the times of flip, behaviour from investors, they just sell out and move to somewhere else, which actually is a good example for the next one. Market segmentation theory. The final one is, which kind of comes back to your point, draw a yield curve again. Treat them as different segments. So you've got like segment there, sorry, like 1, 2, 3, 4 different segments along the yield curve, different time periods. Sorry you guys can't see this over there. But if market segmentation theory suggests that there's different supply and demand at different levels along the yield curve, again this kind of contradicts expectation theory a bit, but if the yield curve's flipping or starting to become humped, the yield curve starts to become humped. This is because supply and demand has shifted from this one, but people have kind of left there and went over to shorter term debt. So if we're thinking a recession is going to happen, the demand will drop at the longer dated bonds, which lowers the yield curve, lowers the interest rate, and they'll move to the shorter term, and then they'll bring shorter term debt up. If demand drops here, what happens when demand drops? Price drops, so the yield curve starts shifting. But obviously, if demand drops here, then demand elsewhere is going to go up. Shorter term, which starts moving that up. Yeah. And if you kind of, I can't do 3D, but in the longer term, if there's no demand here, that drops the interest rate right down here. But shorter term interest rates, demand might be higher. That will flip the yield curve. So it's quite hard for me to draw that in one diagram, but market segmentation shows you how demand in one segment can shift the demand in another. So that's a good, I suppose that's the best way of explaining the hump. Demand will drop, so price drops, but demand will rise somewhere else. And that's because bond investors are risk averse. When things go bad, they like shorter term things rather than longer term things. So I'll put quite a lot of detail in the slides if you want to have a read of them. But there are 4 things to remember. Expectation theory, we expect longer term interest rates to follow the path of short term. Preferred habitat is compensate people for going outside their comfort zone. Liquidity preference, you're locking in. You want to be compensated for being locking in. And this one is supply and demand is different at different segments along the yield curve. And one change in supply and demand can affect the other supply and demand of a different segment. I've kind of summarised that up on this last slide. You see like which ones are kind of behavioural and which ones are kind of more economic. Economic being expectation theory and liquidity preference, but markets with preferred habitat is certainly behavioural. Okay, so it's investors' behaviour. Have a few read of that. The last slide there is more of a discussion point of view. Is the yield curve the best tool we've got for predicting interest rates? Is there an alternative? Is there any alternatives to how we might look at what the interest rate might be in 10 years' time? There isn't really. You can look to the futures market, but guess where the futures market gets their prices from? Today's yield curve. So it's not perfect. Obviously, there's economic assumptions behind it. There's behavioural assumptions behind the yield curve. But quite frankly, it's the best thing we've got when it comes to looking what future rate changes may be, or kind of what the future economy may look like. So as you're saying here, if you see a hump, then you might suggest a recession's on its way unless the central bank does something about it.